Stop for a moment and pay very close attention, because what just happened in the silver market is not random noise, it is not coincidence, and it is not something you can afford to ignore. Today, silver sent a signal that separates disciplined investors from emotional ones, and if you missed it, you are already behind. Just 2 days ago, the narrative was pure panic. Headlines were shouting collapse. Commentators were confidently announcing that the top was in. Silver had plunged to $87, and the mood across financial media turned almost celebratory, as if the bull market had officially died. Social feeds were full of people saying they saw this coming, that silver was finished, that the rally was nothing more than a bubble finally bursting. Fear spreads fast, and it spreads loud. But then something happened that completely flipped the emotional script. Silver didn't roll over. It didn't drift sideways. It exploded higher. In less than 48 hours, it surged back to $91, a sharp $4 rebound, while those who sold into fear were still processing their losses. That kind of recovery is not just a price move. It is a statement. It is the market reminding participants that impatience gets punished and conviction gets rewarded. The ones who sold at 87 locked in pain at the exact moment strength was preparing to reassert itself. The ones who understood market structure, who recognized forced liquidation for what it was, are now sitting comfortably above their entry. This is how silver operates. It doesn't move politely. It moves violently. It shakes out weak hands, transfers positions to stronger hands, and then continues its path. If you do not understand that rhythm, you will keep reacting at the worst possible time. Before we go deeper into what this rebound truly means and where silver may be headed next, I want you to think about something simple. Where are you watching from right now? Which country? Which city? This market we are discussing is global. There are viewers from Australia, Germany, Nigeria, India, Brazil, Canada, and countless other places, all watching the same price chart. Silver is not a local trade. It is a worldwide asset influenced by forces that cross borders and time zones. When you understand that this community spans continents, you also understand that the information flow and sentiment driving this market are broader than any single headline. Now let's get into what actually triggered this violent rebound, because most of the mainstream commentary is already misinterpreting it. Silver's drop toward $87 happened during a brutal liquidation wave. Chinese institutions were unwinding leveraged exposure. The Shanghai Futures Exchange placed restrictions on deliveries. Algorithms accelerated selling pressure. Stop losses cascaded one after another. It looked chaotic, and emotionally it felt catastrophic, but structurally it was predictable. When leverage builds up in one direction, the unwind is mechanical. What matters is what happens after forced selling exhausts itself. And what happened next was powerful. Silver bounced aggressively. It recovered nearly 3.5% in a single session. It reclaimed the $90 handle and is trading around $90.50 per troy ounce during European trading hours. That is not what a dying market looks like. That is not a weak bounce that fades immediately. When you examine the technical structure, the evidence suggests something more substantial is forming. Let's walk through the technical framework, because charts do not panic and they do not exaggerate. The 14-day relative strength index is sitting around 56. The RSI measures momentum from 0 to 100. Below 30 is considered oversold. Above 70 is overbought. The midpoint is 50. At 56, silver is above the midpoint, which indicates positive momentum, but it is nowhere near overheated conditions. There is space for continuation. There is fuel left in the tank. Momentum is not stretched. It is building. Now consider the moving averages. Silver is holding above both the 9-day and the 50-day exponential moving averages. In technical analysis, that matters. When price trades above key moving averages, it signals strength. When it falls below them, it signals deterioration. The 9-day EMA is around 843. The 50-day EMA sits at $79.94. Silver is trading well above both of those levels. That is constructive. More importantly, the short-term 9-day EMA has begun turning higher. It is no longer flat. It is rising and separating from the flatter 50-day EMA. In plain terms, that means upside momentum is accelerating relative to the broader trend. This is not an exhausted rally gasping for breath. This is a recovery phase with room to extend. So what levels matter next? On the upside, the first major psychological barrier is $100. That number carries weight beyond mathematics. Round numbers attract attention. They concentrate option strikes. They cluster stop orders. They create headlines. Every retail participant who has ever followed silver knows that $100 level, it is a magnet. But beyond $100 sits an even more important milestone, the record high of $121.66. That is the previous peak. That is where the last rally topped out. If silver pushes through 100 and challenges 121.66, the conversation shifts dramatically. At that point, we are discussing breakout territory and price discovery, where prior resistance transforms into structural support. On the downside, there are clear levels to monitor. The first line of support remains the 9-day EMA around $8,443. If price pulls back, buyers are expected to defend that region. Beneath it, the 50-day EMA at $79.94 becomes the secondary defense zone. If both fail, the structure weakens and reassessment becomes necessary. The 2-month low at $648, reached during the height of panic, marks the extreme boundary. A return there would signal serious trouble. But as long as silver remains above clustered moving average support, the path of least resistance favors higher prices. That conclusion comes from chart structure, not emotion. There is also something intriguing happening in the options market. Options positioning often reveals where informed participants expect movement before it materializes in spot price. Gold options currently display a more cautious configuration. Hedging activity against downside risk is concentrated, while upside positioning is more dispersed. That reflects defensiveness among gold traders. Silver's options landscape tells a different story. Bullish silver positioning shows stronger consensus. While call accumulation is scattered rather than focused at a single strike, the directional bias leans upward. In simple terms, options traders appear more confident in silver's upside than gold's at this moment. That divergence is meaningful. When silver begins outperforming gold, it often indicates industrial and monetary dynamics specific to silver are asserting themselves rather than silver merely following gold's lead. At the macro level, external forces are also aligning. Tariffs have returned to center stage. The United States has begun collecting a temporary 10% global import tariff, with discussions underway about increasing that levy to 15%. That shift represents more than a minor policy adjustment. It signals structural change in global trade flows. Tariffs introduce uncertainty. They create inflationary pressure. They add friction into economic systems. When uncertainty rises and inflation concerns intensify, investors seek refuge in hard assets that cannot be printed or legislated away. Gold and silver historically benefit from such environments. The legal back and forth surrounding tariff authority has amplified that uncertainty, reinforcing safe haven demand. Meanwhile, geopolitical discussions involving Iran add another layer of unpredictability. Elevated geopolitical tension historically correlates with precious metals' strength. When you combine supportive technical structure, improving momentum, bullish options sentiment, tariff uncertainty, and geopolitical risk, you begin to see a convergence of forces that explains why silver did not collapse after hitting $87. Instead, it rebounded with conviction. This is not randomness. This is structure meeting psychology, and understanding that difference changes how you respond the next time volatility tests you. Today, while many investors remain distracted by short-term headlines, the deeper forces shaping the precious metals market are quietly reinforcing the case for silver. Technicals alone never tell the full story. Charts reflect behavior, but behavior is driven by macro conditions, policy decisions, and global capital flows. When you combine what we discussed earlier with the broader economic environment, the recovery from $87 to $91 begins to look less like a random bounce and more like a market responding to layered structural pressures. Let's begin with monetary policy, because that is always part of the conversation. Two Federal Reserve officials recently signaled very little appetite to alter the central bank's current stance in the near term. In plain language, that means rates are expected to remain elevated. Traditionally, higher interest rates create headwinds for precious metals. Gold and silver do not yield income. When Treasury bonds offer attractive returns, holding a non-yielding metal appears less compelling on paper. The opportunity cost rises. That is the conventional framework. Yet despite that backdrop, gold moved higher and silver moved even more aggressively. That divergence from the traditional narrative matters. It suggests that the market's motivation is not solely tied to rate differentials. Instead, investors appear focused on broader systemic considerations. When governments run massive deficits, when debt expands at an accelerating pace, when fiscal and trade policies shift unpredictably, investors begin reassessing long-term currency stability. Hard assets become attractive not because they pay yield, but because they represent tangible stores of value outside the direct control of policymakers. Silver's 3.5% gain and platinum's surge of over 5% occurred despite confirmation that rates are not changing. That tells you something about priority. The market is pricing in concerns that outweigh simple yield comparisons. It is responding to risk, uncertainty, and structural imbalances rather than short-term monetary tweaks. The dollar has also weakened slightly, which adds another supportive layer. When the dollar declines, dollar-denominated commodities become relatively cheaper for international buyers. Even marginal shifts in currency valuation can influence demand at the edges. This factor alone does not drive a rally, But combined with technical strength and macro tension, it contributes to upward pressure. Markets rarely move for one reason. They move when multiple forces align in the same direction. Zooming out further, perspective becomes critical. Silver reached a record high of 2166 earlier in this cycle. That was an extraordinary move that generated enthusiasm and, for many, substantial profit. Following that peak, silver corrected sharply. The drop to $87 represented approximately a 28% decline from the high. Painful? Absolutely. Surprising? Not if you understand silver's historical behavior. Silver does not climb in gentle increments. It surges, consolidates, retreats violently, and then surges again. Volatility is embedded in its DNA. It is the mechanism through which positions are redistributed. Markets that trend too smoothly attract complacency. Silver rarely offers that luxury. The speed of the rebound from $87 provides insight into underlying demand. Weak markets do not snap back with force. They drift lower, rally weakly, and then continue fading. Strong markets, by contrast, absorb liquidation and respond with aggressive buying. The presence of willing buyers at depressed levels is what differentiates structural strength from speculative froth. The rebound toward $91 indicates that capital was waiting. That does not guarantee uninterrupted upside, but it does confirm that demand remains active. It is also useful to examine related industrial indicators. Copper prices on the London Metal Exchange have moved back above $13,000 per ton. Chinese market participants returning from Lunar New Year holidays increased import appetite, signaling re-engagement in industrial demand. Copper is often referred to as a barometer for economic activity because of its extensive use in manufacturing, construction, and infrastructure. Rising copper prices suggest industrial activity is stabilizing or strengthening rather than collapsing. This matters because silver occupies a dual role. It functions as both a precious metal and an industrial input. Electronics, solar panels, electric vehicles, and advanced manufacturing processes rely on silver's conductivity. When industrial demand remains resilient, it reinforces the fundamental case for silver beyond safe haven flows. Analysts observing copper note early signs of demand recovery. They are monitoring whether import arbitrage remains open and whether inventory draws persist. While elevated inventory levels may moderate short-term tightening, the directional trend is constructive. The broader metals complex appears supported rather than strained. Platinum's simultaneous 5% surge adds confirmation that this is not isolated movement. Strength across multiple precious and industrial metals suggests systemic capital allocation rather than idiosyncratic fluctuation. Returning to silver specifically, key technical markers remain central. The 9-day EMA at 8,443 functions as short-term structural support. As long as price remains above that zone on pullbacks, the bullish configuration holds. Beneath it lies the 50-day EMA at $79.94, representing a more substantial defensive layer. A decisive breakdown below both would alter the narrative significantly. For now, however, price remains comfortably elevated above those thresholds. Momentum indicators remain constructive. The RSI at 56 indicates expansion capacity without immediate overheating. This balance between strength and restraint is often characteristic of early continuation phases, rather than late-stage exhaustion. Attention should also remain on the $100 psychological level. Markets rarely move cleanly through round-number resistance on the first attempt. Volatility typically increases as traders test conviction. Expect noise around that region. Expect potential spikes above, followed by sharp retracements. Psychological magnets attract liquidity, and liquidity invites volatility. The first approach may not hold. The significance lies not in the initial test, but in whether subsequent consolidation builds a foundation for sustained movement. The gold-to-silver ratio provides additional context. Historically averaging between 50 and 60, this ratio reflects relative valuation between the two metals. When the ratio declines while both metals rise, silver is outperforming gold. That scenario often signals broader strength across the precious metals complex. If silver begins leading, it suggests growing industrial and speculative participation beyond simple safe haven flows. Physical market dynamics remain equally important. Paper markets can exaggerate sentiment, but physical premiums and delivery volumes reveal genuine supply-demand balance. If physical premiums remain elevated while spot prices recover, that confirms real demand rather than purely speculative positioning. Inventory levels at major exchanges, delivery data, and regional premiums offer insights that charts alone cannot provide. The physical market ultimately enforces reality. Now consider the psychological component of recovery rallies. After a sharp drop and rebound, participants fall into distinct categories. Those who bought during the decline feel validated, their conviction was rewarded quickly. However, early success can breed overconfidence. Markets have a way of humbling excessive certainty. Those who sold near the bottom often experience regret. That regret can lead to chasing price at higher levels, compounding mistakes. The third group, those who held steady without buying or selling, may feel conflicted. They avoided losses but missed potential gains. Each psychological response carries risk. Recognizing which category you occupy allows you to adjust behavior before volatility returns. Silver will test participants again. It always does. Volatility is not an anomaly. It is the norm. The key difference between repeated frustration and strategic success lies in preparation. Understanding structural support levels, monitoring momentum indicators, observing options positioning, and tracking macro catalysts creates a framework for decision-making rather than emotional reaction. At present, the evidence tilts constructive. Technical structure remains intact. Momentum is positive without being stretched. Industrial metals show signs of stabilization. Tariff uncertainty and geopolitical tension contribute safe haven demand. The dollar's slight weakness adds marginal support. None of these factors individually guarantee continuation. Together, they create alignment. The critical question moving forward is sustainability. Can silver hold above $90 consistently? One session above a level can be dismissed as noise. Multiple sessions suggest reclamation. Consolidation above 90 would strengthen the pathway toward 95 and eventually the $100 threshold. Conversely, failure to maintain 90 would signal vulnerability and warrant closer examination of support zones. Markets operate on probabilities, not certainties. The goal is not perfect prediction. It is disciplined positioning aligned with prevailing evidence while managing downside risk. Silver's behavior following the plunge to $87 demonstrates how quickly sentiment can reverse. Those who interpret volatility as opportunity rather than catastrophe position themselves differently. The coming sessions will reveal whether this rebound evolves into continuation or transitions into consolidation. Watching how price behaves around established technical markers will provide guidance. Maintaining flexibility while respecting structure will be essential. Today's recovery is not merely a bounce on a chart. It is a reflection of intersecting forces, technical, macroeconomic, psychological, and structural, converging at a pivotal moment. Understanding those forces allows you to engage the market from a position of awareness rather than reaction. Today, everything we have discussed comes down to positioning, discipline, and understanding how markets transition from panic to opportunity. Silver's move from $87 back toward $91 was not just a relief rally that can be dismissed casually. It was a demonstration of how quickly sentiment flips when structural support reasserts itself. The real question now is not what already happened. The real question is what happens next, and more importantly, how prepared you are for the next phase of volatility. Let's begin with scenario planning, because intelligent investing is about mapping probabilities rather than predicting certainties. The first scenario is controlled consolidation. Silver could trade between 88 and 93 for an extended period, allowing momentum to stabilize while building a base. This type of action may appear boring on the surface, but it is often the healthiest path forward. Sustainable trends require periods of digestion. Sideways movement above reclaimed levels can strengthen support and reduce the likelihood of sharp reversals. If silver holds this range and gradually pushes toward 95, the eventual approach to $100 becomes structurally supported rather than impulsive. The second scenario involves acceleration. Silver could advance rapidly toward $100 with little consolidation. Fast moves often generate excitement and attract late participants. However, major psychological levels rarely give way without resistance. A swift run toward $100 could be followed by rejection, sending price sharply lower toward the mid-80s or even lower. Such volatility would punish those who chase emotionally. Markets often inflict maximum frustration before establishing durable trends. A failed initial attempt at $100 would not invalidate the larger bullish case, but it would remind participants that resistance must be tested and retested before it breaks. The third scenario is failure. Silver may struggle to hold above $90, break below the 9-day EMA at 8,443, and then test the 50-day EMA at 79,994. A breakdown beneath both moving averages would weaken the bullish structure significantly. In that case, a retest of the 2-month low at $648 could enter consideration. This scenario currently appears less probable based on present evidence, but it cannot be dismissed outright. Markets do not operate on guarantees. They operate on shifting conditions. A fourth scenario involves external shock. Tariff escalation could intensify beyond expectations. Geopolitical negotiations could deteriorate unexpectedly. Financial institutions could face stress that spills into broader markets. In such an environment, silver could move violently in either direction depending on how capital reallocates. Black swan events are, by definition, unpredictable. What can be controlled is preparation. By acknowledging the range of possibilities in advance, investors reduce the risk of emotional paralysis when volatility strikes. Beyond scenarios, there is an important psychological lesson embedded in this recovery. The moment you become absolutely certain about an outcome is the moment risk increases. Certainty narrows perspective. It blinds participants to contradictory evidence. It encourages oversized positions. Successful market participants maintain informed conviction while remaining adaptable. They respect structure, but they do not worship predictions. They monitor evidence and adjust accordingly. Let's return to specific indicators worth watching. First, sustained action above $90 is critical. Reclaiming a level is one step, holding it is another. If silver can remain above 90 for multiple consecutive sessions, confidence in the recovery strengthens. Consolidation above that threshold would signal absorption of supply and preparation for the next advance. Failure to hold would shift focus back toward support zones. Second, monitor the RSI. At 56, momentum remains positive without excess. If the RSI pushes into the 60s alongside rising price, that suggests healthy expansion. If it climbs above 70 rapidly, overbought conditions could invite consolidation. Momentum divergences, where price rises but RSI stalls, often precede pullbacks. Paying attention to these signals allows for informed risk management rather than reactive decisions. Third, observe the gold to silver ratio. Continued decline in the ratio while both metals appreciate would confirm silver outperformance. That dynamic often accompanies powerful phases in the precious metals cycle. If silver begins leading gold consistently, broader participation may follow. Fourth, continue tracking physical market indicators. Elevated premiums and stable delivery volumes reinforce genuine demand. If physical dynamics contradict paper price movements, caution may be warranted. Ultimately, physical supply and demand anchor long-term trends. Fifth, keep awareness on macro catalysts. Tariff policy developments, fiscal debates, currency fluctuations, and geopolitical tensions will continue shaping investor sentiment. Precious metals respond not only to numbers on a chart, but to confidence in systems. When trust erodes, hard assets gain appeal. That dynamic extends beyond short-term rate policy. Let's also revisit the broader metals complex. Copper holding above $13,000 per ton suggests industrial demand resilience. Platinum's significant surge supports the idea of systemic strength across metals. When multiple metals move in alignment, the probability increases that capital flows are shifting at a higher structural level. Silver benefits from both industrial usage and monetary appeal, placing it at the intersection of these forces. Another critical element is discipline during volatility. The recovery from $87 illustrated how quickly markets can reverse. Those who sold at the bottom locked in losses permanently. Those who maintained perspective allowed structure to guide them. Emotional decisions often occur at extremes. Recognizing that pattern is essential. Silver's volatility is not an anomaly, it is inherent. Accepting that reality changes how one allocates capital and manages exposure. Looking ahead, if silver approaches $100, volatility should be expected. Headlines will intensify. Retail interest may spike. Option activity may concentrate. The first test could fail. The second could hold. Patience during that process will matter more than prediction. Breakouts rarely occur in straight lines. It is also important to remember that market participation is not about winning every move. It is about positioning correctly when probabilities align and limiting damage when they do not. Risk management is not a defensive mindset. It is the foundation of sustainability. Silver's capacity for rapid movement magnifies both gains and losses. Structure and planning mitigate that amplification. Now consider the broader narrative. Tariff implementation at 10% with discussion of increasing to 15% signals structural trade shifts. Legal disputes over authority add uncertainty. Geopolitical discussions add unpredictability. Federal Reserve policy remains restrictive, yet silver advanced despite higher rates. That combination indicates underlying demand drivers beyond conventional rate sensitivity. Investors appear to be weighing systemic risk and currency stability more heavily than yield differentials. The interplay between macro conditions and technical strength creates opportunity when aligned. Currently, moving averages support price. Momentum indicators allow expansion. Options positioning leans bullish relative to gold. Industrial metals show resilience. Currency weakness adds marginal support. None of these alone guarantee continuation. Together, they create a framework suggesting upward bias while acknowledging volatility. As this cycle unfolds, humility remains essential. Markets can and will surprise. The objective is not to predict every fluctuation. It is to understand structure well enough to avoid being shaken out by noise. Silver's recovery demonstrates that fear-based selling at extremes often precedes rapid reversals. Awareness of that pattern is itself an edge. If silver consolidates above $90 and advances toward $95, momentum may accelerate toward $100. If it fails to hold reclaimed levels, defensive adjustments become necessary. The difference between success and frustration often lies not in forecasting accuracy, but in reaction quality. Ultimately, the market rewards preparation. It punishes complacency. It exposes overconfidence. Silver's behavior from $87 to $91 is a reminder that volatility is opportunity disguised as discomfort. Those who remain grounded in structure, disciplined in execution, and adaptable in mindset are better positioned to navigate what comes next. The path forward will not be smooth. There will be pullbacks. There will be headlines designed to provoke reaction. There will be moments where conviction is tested, but understanding moving averages at $8.43 and $79.94, recognizing the significance of $100 and $121.66, monitoring the 2-month low at 648, and observing RSI at 56 provides context that emotion cannot. Today, silver delivered a message. The question is whether that message is heard clearly. The market does not announce its intentions loudly. It signals through structure, momentum, and response to stress. Interpreting those signals with discipline transforms volatility from threat into advantage.